Hey, welcome back. A lot moved in crypto this week. The first topic is around Bitcoin is consolidating just under $120,000, with analysts flagging Ethereum ETF inflows as the key signal for the next breakout. Bitwise CIO, Chief Investment Officer, projects the end of the Bitcoin's 4-year cycle and sees a safer market ahead, fueled by rising institutional inflows. Now, this makes sense because there's a lot of new catalysts that's changing the dynamics of Bitcoin beyond the traditional 4-year halving cycle. We've got the ETFs that's been approved since January 2024. We've also had a pro-crypto US administration back in office. We also had a whole heap of new plethora of Bitcoin treasury companies that are adding into their corporate positions in Bitcoin. Also, we have other Bitcoin-backed financial products that's coming out into the marketplace, particularly to solve the Bitcoin hodlers' predicament on creating a yield off their Bitcoin holdings. So there's a lot of reasons why it's just simply broken, just doesn't work anymore. What we will be seeing is perhaps a more prolonged bull market and smaller bear markets, perhaps more sharper than ever before, but they're going to be short-lived and rebounded into brand new highs. So I think that's the new set of dynamics in Bitcoin that we're going to be seeing moving forward. The next on the list is on the spot ETF infrastructure shift. Now, there's been a recent approval of the in-kind Bitcoin and Ether ETFs, allowing issuers to swap crypto directly for fund shares, dramatically improving liquidity and reducing market impact during creation and redemption. Now, this design could make ETFs a long-term liquidity anchor, setting the stage for tighter spreads, better price discovery, and deep integration between TradeFi and crypto. So basically, this is just another way to improve on the underlying ETF infrastructure. What they're trying to do is trying to find a tax-exempt way to bring in additional capital, net new money into those spot ETF shares without incurring tax levies or tax burden on those investors. So the way to achieve that is to, as I just said, to swap existing crypto asset holdings that these investors may have into the underlying spot ETF shares, whether it's Bitcoin or Ethereum. This is the great news, and like I said before, it's just another way to bring in more capital from TradeFi into the crypto market. So this is a positive outcome that we've seen this week. The next one on the list is to do with Bitcoin network hash rate is approaching a new record, almost 943 exahash per second, underscoring robust miner participation and strengthening the network security even amid margin pressure. Now, despite tightening margins, miners are scaling aggressively, and US listed mining firms now control nearly 20% of the global block rewards. Now, in my previous video, which is all the more reason why you have to subscribe to this channel to learn a little bit more on those news and developments that I regularly publish, I have explained that there is a correlation between the upside of the hash rate of Bitcoin and its price. So the higher the hash rate, the more difficult it is to break the network, the Bitcoin network, so it actually strengthens it and make it more resilient, and the price of Bitcoin usually goes up. So that is an interesting correlation that we're going to be seeing more and more, particularly where there's more capital drawn into the Bitcoin network. We're going to be seeing that tightening or that coupling between the hash rate and the price of Bitcoin. It means that it will make the Bitcoin network much more resilient in advent of any possible hacks or attacks. So this is a good news, particularly for us Bitcoin investors. The next one on the list is on DeFi and payments expansion. Now, the total value locked in DeFi has surged to a 3-year high of 153 billion US dollars, driven by Ethereum restaking protocols, lending and institutional capital chasing yield. PayPal just rolled out Pay with Crypto for US merchants, supporting over 100 cryptocurrencies and slashing on those cross-border fees by up to 90%. Now, again, I made videos on the resurgence of DeFi we are seeing. Now, ever since the Clarity Act, which is in the middle of being approved, that's going to provide even more bullish sentiment and push on the DeFi project, which were pretty much at a standstill, whilst this Regulatory Clarity Act is being passed in both the Senate and the House. Now, once that happens, we're going to be seeing DeFi projects explode into the foreseeable future. So it's no surprise that we are seeing the Ethereum ecosystem taking the lead charge on DeFi projects, because as I said in my previous episodes, Ethereum is currently the largest smart contract blockchain there is in terms of TVL, and also Solana is catching up, and there's also layer 2 side chains on Bitcoin that's starting to introduce that smart contract programmability in its Bitcoin ecosystem. And it's no surprise as well to see the likes of PayPal, they need to position themselves into this DeFi projects space, which makes total sense. The next on the list is on the US regulatory and institutional signal. Now, the Trump administration plans to expand crypto into US mortgages and on those 401k, which are like the retirement plans. This marks a major policy pivot towards integrating digital assets into mainstream finance. Trump's team is reportedly planning on an open architecture access to DeFi protocols and considering low-tax crypto zones to attract innovation and capital. Like I said before, there's been a lot of movement in increasing the amount of pension plans allocations to Bitcoin. Now, what Trump is trying to do is trying to actually legislate that into a much broader spectrum of retirement plans and even mortgages, right? Which is interesting. So this comes to show that there is that bullish sentiment that the US is certainly taking its strategic aim to become that crypto capital in the world. And these sort of gestures and policy decisions really add to that aim. So that is a bullish sentiment. And even the more interesting part for me is the policy decision on considering the possibility of establishing low tax crypto zones in order to attract innovation and capital. Again, I have actually forecasted this trend in many of my videos in the past, because it just doesn't make sense in the 21st century digital era that we live in for governments worldwide, particularly the Western countries, to continue to levy upon us this rather antiquated and onerous tax regime. It just doesn't make any sense whatsoever. So they need to do a complete overhaul, because if they don't, they're going to be left behind, and there's going to be a swathe of capital and talent exodus from those countries who failed. So I really applaud Trump's decision on considering low tax crypto zones to attract that innovation and capital, right? So kudos to Trump on that. And this brings into my last point on Arbitrum's $10 million audit push. Now, Arbitrum is allocating $10 million to fund third-party smart contract audits for projects building on its network, a move aimed squarely at improving DeFi safety and avoiding the recurring damage from exploit-driven collapses. Now, this is likely a preemptive response to the incoming Clarity Act and broader regulatory scrutiny, where formal audits may become non-negotiable for legitimacy and investor confidence. So for investors, this marks a clear shift. Audited projects may soon become a baseline requirement. Unaudited protocols could face capital flight and reduce market credibility as compliance becomes part of due diligence. So all this means one thing, that we're going to be rooting out those unlicensed, unvetted DeFi exchange platforms, right? Because given the state of the crypto regulation, which is spearheaded by the US administration with this Regulatory Clarity Act business, what they're trying to do is they want to bring in lawful operators, lawful DeFi fintech players into the space to actually instill confidence and drawing the capital from its investors into those DeFi projects. And the only way to do that, honestly, is to legislate the Clarity Act. That's number one. But number two, they need to start getting used to being vetted. Those smart contracts on those blockchain projects, they need to get used to auditing their work, their blockchains, by an outside third-party auditing firm, because that's the only way to provide complete transparency and verifiability of their blockchain projects, to make sure there aren't any loose ends, there aren't any possible hacks embedded in those smart contracts, which will then provide maximum transparency and confidence towards the investing public. So that is great news, and this is something that, you know, the fintech players will just have to get used to and incorporate into those budgets every year. So this will bring more confidence and particularly more consumer protection of those blockchain tokens. So this is good news all round. So that's all I like to leave you today. There's an awful lot that I've covered, and my message still remains as always: invest wisely and invest in Bitcoin. Until next time.